Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing AppLovin stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 49 billion market cap. They're trading at $147 a share, and they have 334 million shares outstanding. AppLovin builds a software-based platform for advertisers to enhance the marketing and monetization of their content. It operates through two segments, software platform and apps. The company's software solutions include App Discovery, a marketing software solution which matches advertiser demand with publisher supply through auctions. Another product is called Max, an in-app bidding software that optimizes the value of a publisher's advertising inventory by running a real-time auction. They also offer Adjust, a measurement and analytics marketing platform that provides marketers with the visibility, insights, and tools needed to grow their apps from early stage to maturity. Wurl, spelled W-U-R-L, a connected TV platform that distributes streaming video for content companies and provides advertising and publishing solutions. It also offers Spark Labs, which uses App Store optimization to enhance ad visibility. AppLovin Exchange, that connects buyers to mobile and CTV devices, as well as Array, an end-to-end app management suite for mobile operators and end users. In addition, the company operates various free-to-play mobile games. They serve individuals, small and independent companies, enterprises, advertisers, mobile app publishers, indie studio developers, and internet platforms. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had amazing growth from 22 to 23. It went from 400 million to over 1 billion, 157% growth. Even higher in the trailing 12 months to 1.4 billion, up 33%. Look at those margins, 36%. They convert 36% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. A small positive in 2021, a negative in 2022, back to positive in 23, and their highest ever, over 800 million in the trailing 12 months. Pretty solid margins, 21%. Revenue is a sales for the company, and that goes up each year from 2.8 billion to 4 billion. So their financials are solid. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's 51 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $44 billion. We divide that by 330 million shares. And we get a calculated stock price of 131. They're trading at 147, so they're trading at a 12% premium. It's a sell according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 225 companies in the same industry as App, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't really need to spend much in CapEx. They're a software company. They have the worst debt to equity ratio. They use a lot of debt to fund their growth. For every dollar of equity, $4.30 of debt. That's a bit concerning. They generate a lot of free cash flow, 1.4 billion. They rank 12th in market cap. Salesforce is number 2. I think they used to be number 1. They look really overvalued according to their price multiples. Price to book is stock price over book value per share. They're trading at 58 times book value. PE is stock price over earnings per share. They're trading at 60 times earnings. That's better than the average. Price to free cash flow is stock price over free cash flow per share. That's pretty close to the median. Price to sales is stock price over revenue per share. They're trading at 12 times revenue. They generate 4 billion of revenue, which is better than the median average. And we can't look at their 5-year annual revenue growth rate. They have not been public that long. Datadog is number 1 at 55%. So to summarize, I have them trading at a 12% premium. I give them a ranking of 6 out of 10. Would I buy them 8 out of 10? It seems like this company is really trending up. And I think there's a lot of upside potential, even though I say it's overvalued, because as you know, the market is irrational. Ratios 3 out of 10, all their ratios are worse than median. Financials 8 out of 10, amazing financials. Free cash flow up nearly 300% from 2021. Revenue up 42% since 2021. So they've done a great job at managing expenses and becoming efficient and profitable. Let's take a look at their latest 10Q. Here's their income statement, the second quarter of 24, second quarter of 23. This is the first half of 24 compared to the first half of 2023. Revenue is going up a lot. It was $750 million last year. Now it's a little under $1.1 billion. Even more impressive is their expenses didn't go up that much. It went from $618 million to $689 million. So their income from operations tripled, $130 million, almost exactly tripled, to $391 million. Expenses in all four categories went up, but it went up slightly, while revenue grew dramatically. That's why their margins improved so much. Let's see if they give a breakdown of the revenue so we know what it is. Of the $369 million of app revenue, $250 million is in-app purchase revenue, so spending money on the app. $118 million is selling ad space on the app. So $369 million plus $711 million gives you the $1.08 billion of revenue. $630 million of revenue is in the US, $448 million in the rest of the world. Say you have an app that offers a game for people to play. Whether you charge money or not for the game, you want to get lots of people to play the game. Sometimes it's hard to reach a lot of people, especially if your marketing dollars are limited. AppLovin will run ads on those people's phones and get people to hopefully download your app. And the more people that download your app and use it, the more you can charge for advertising space. And if you charge a fee to use your app, hopefully the more people sign up and start paying. You can also sell ad space on your app. This company will offer auctions for other businesses to buy ad space on your app. They talk a little more about their revenue. Our software platform revenue increased $305 million, or 75%. So it went from $400 million to $711 million. That's up 75%. That's due to improved app discovery performance. That's one of their products, App Discovery, when net revenue per installation increased 7% and the volume of installations increased 77%. Our app revenue increased $25 million, or 7%. So their app revenue went from $344 million to $369 million, up only 7%. That was a $17 million increase from IAP revenue from apps. IAP is in-app purchases, and that's due to a 3% increase in the volume of in-app purchases and a 4% increase in price per in-app purchase. And in-app advertising revenue from apps increased $8.1 million, or 7%. Due to a 56% increase in the volume of advertising impressions, partially offset by a 31% decrease in price per advertising impression. The big winner is software platform revenue. That grew the most. Total revenue up 44%. It's even higher in the trailing 6 months. Software platform revenue up 83%. Software platform revenue is generated from fees collected from advertisers and advertising networks who use the software platform. The majority of the software platform revenue is generated through App Discovery and Max. That provides the technology to match advertisers and owners via auctions at large scale at really fast speeds. Let's learn more about App Discovery. It's pretty straightforward what App Discovery is. It's just marketing for app developers, so their apps get noticed and people download them. There are over 1.5 million apps in the App Store and more than 2 billion smartphones in circulation. So it's hard to reach the right people. That's why you need a company like this to help you advertise. Let's break down their expenses. All line items on the income statement are as a percent of revenue. Cost of revenue is 26% of revenue. Last year was 34%. Really nice improvement. The reason cost of revenue went up $35 million was associated with operating their network infrastructure, driven by the growth in their software platform operations. So as more people use it, they have to spend more money, but they're spending a lot less per user. And that was offset by a decrease of $12 million in amortization of intangible assets. Sales and marketing was 26% of revenue, now it's 19% of revenue. Sales and marketing increased about $10 million. That was due to an increase of $12 million in personnel-related expenses, due to an increase in stock-based compensation. That was offset by a decrease in user acquisition costs of $6.2 million. So they lowered their user acquisition costs. Then you have R&D that went from 18% of revenue to 15% of revenue. R&D increased 26 million. That was due to an increase of 20 million in payroll and an increase of 5 million in professional services related to the cost of development of new games by third parties. Then you have G&A, 4% of revenue, same as last year. G&A increased 10 million, and that was mainly due to an increase in payroll. They have a lot of debt. 7% of their revenue went to interest payments on the debt. Interest expense went up 24 million due to a net gain of 21 million related to interest rate swaps. So it looks like they were hedging the interest rates on the debt. When we get to the balance sheet, we'll dig into the actual debt. So total expenses went down. It was 82% of revenue, now it's 64%. So operating income is 1 minus 64%, or 36%. Their net income margin went from 11% to 29%. Let's take a look at their balance sheet. Assets, 5.3 billion, similar to last year. Their current assets, 1.7 billion. Current liabilities, 700 million. So current ratio, a little above 2. They have plenty of current assets to cover their current liabilities. 460 million of cash, that went down a little bit. 1.1 billion of receivables. That's a lot of receivables. That's how much money is owed to them when they sell on credit. Then you have your non-current assets. Property, plant, and equipment, 169 million. Goodwill is their biggest asset, 1.8 billion. Here's a breakdown of the goodwill. 1.5 billion of the acquisitions is from software, 345 million from apps. That's how you get to 1.8 billion. More intangible assets, 1.1 billion. So they do a lot of acquisitions. That's why they have a lot of debt. Here's a breakdown of the 1.1 billion. The asset apps, 1.8 billion. They amortize 1.3 billion. So the net book value is what you see on the balance sheet, 533 million. Customer relationships, that has a useful life of 8 years, so it gets amortized over 8 years. Gross value, 515 million minus 136 million. Book value, 380 million. User base, 69 million. They amortize 52 million, so the book value is 17 million. License asset, 61 million minus 38 million, that equals 23 million. Developed technology, 206 million minus 100 million equals 101 million. And then other, 75 million minus 27 million equals 49 million. Then you have other assets, 516 million. That's a lot in the other bucket. They don't explain what's in the other bucket. Maybe they do on their 10K. Liabilities, 4.5 billion. 390 million accounts payable. This is how much money they owe when they buy on credit. Accrued expenses, 230 million. This is when a company has incurred an expense but hasn't paid it yet. Payroll is a popular type of accrued expense. 36 million of short-term debt, that's due within 12 months. Deferred revenue, 74 million. This is when a company receives money in advance before providing the product or service. This happens a lot with gift cards. When you buy your Starbucks gift card, you're giving Starbucks money before you buy any coffee. So it sits on the balance sheet as a liability. When you actually use the gift card and buy coffee, then they remove the liability from the balance sheet and book revenue onto the income statement. The most important thing, the number that really sticks out like a sore thumb, is a debt. 3.5 billion of debt. That's a lot of debt for a company this size. They don't talk much about the debt, as if they're hiding it. It's kind of odd. Right here they say, we are party to a credit agreement that provides for senior secured credit consisting of term loans and a facility with varying maturity dates through 2030. So they're gonna have a lot of debt due over the next 5 years. Their facility is 3.55 billion. There can be no assurance that they'll be able to repay the debt. Every company has to say that. It's kind of like a legal thing. Usually companies list debt by year. Like 1 billion is due in 2026, 1 billion is due in 2027, $500 million is due in 2028, and they also show the interest rate. But this company doesn't really talk much about their debt. 3.5 billion of debt. We'll look at their statement of cash flows in a little bit to see if they can cover the debt. Assets minus liabilities equals equity, 800 million of equity. They raised 1.2 billion from selling their business. They lost 266 million from running their business. So they have 3.5 billion of debt. Let's look at their cash flows to see if they can cover that. 850 million of operating cash flow. So it's about a year of operating cash flow to cover the debt. So I guess they have enough to service their debt because they just have to pay the interest on it. At least now they just have to pay the interest. When the debt is due in 2, 3, 4, 5 years, then they have to pay the principal. But hopefully by then, operating cash flow is much higher. At least that's the goal when you take on debt, to increase your cash flow so you can more than cover the debt. Because if you took on debt and say paid 6% interest and you bought another company, if that company resulted in a 5% return, you'd be losing 1%. If that company resulted in a 20% return, you're up 14%. So let's go through their statement of cash flows. The first section is operating cash flow. The way you calculate operating cash flow, you start with net income, $546 million. Then you add or subtract the non-cash items from the income statement. We add back amortization and depreciation, $220 million. Add back stock-based compensation, $200 million. It looks like they extended a lot of credit. They sold $125 million of product on credit. They didn't receive the cash, so it's a cash outflow. When people pay them, when those customers pay, then it'll be a cash inflow in that accounting period. So operating cash flow is up more than 50%, $518 million to $847 million. They don't have any CapEx. Software companies usually don't have much in CapEx. Microsoft has a lot in CapEx because they make computers and not just software. But AppLovin is a pure play software company. They spent $100 million in investing activities. Acquisitions go into this bucket. So in prior quarters, this number was probably pretty high because it looks like they did a lot of acquisitions in the past. They're buying back a lot of stock, $750 million. Last year, $570 million. I'd rather them pay down debt than buy back stock. But either way, they're returning funds to shareholders because when you pay down debt, that's less interest you have to pay on that debt in the future. So in a roundabout way, it's giving back to the shareholders. Buying back stock is a direct way to give back to shareholders. It's kind of like if your mother gives you $100 to put into the bank. That's direct. That's like a buyback. But if your mother spends $1,000 on a math tutor over a few weeks, that's an indirect way of giving you money because maybe you'll be smarter, go to college, get a good job. They issued a lot of debt. They issued $1 billion of debt. That's where they got all the funds to buy back stock and pay down the debt. They have a lot of stock-based compensation. Giving stock to your employees is free, but the company does have to pay taxes on that stock. They paid $436 million of taxes. So it's not totally free. To pay $436 million of taxes, they must have given away a couple of billion of stock. So in their financing section, they had a cash outflow of $785 million. I'm getting a little concerned with the amount of debt they have. The operating cash flow looks good, but something doesn't sit right. You see cash at the beginning of the accounting period, $500 million. At the end of the accounting period, $460 million. The way you get from the beginning to the end, it's a sum of operating cash flow, investing cash flow, and financing cash flow. The sum of those three is about negative $40 million. Remember these two numbers, $502 million, $460 million, cash at the beginning and end of the period. Let's go back to the balance sheet. You see that in the balance sheet, $502 million in 2023, now it's $460 million. That's how the statement of cash flows and balance sheet are tied. Actually, all the financials are tied in some way. Let's look at the stock on Simply Wall Street. Its last price, $147, 48 billion market cap, up 5% in the past week, up 280% in the past year. Wow. The stock IPO'd in April 2021 at $60. 7 months later, it was over $100. There was a lot of hype on this stock, and then it came down about 90% from November 2021 to January 2023. 14 months later, down to $10. Imagine you bought it at 100 and it's down to 10. You'd probably totally give up on the stock, not realizing it would easily break through 100. In December 2022, it hit its all-time low at 948. By December 2023, it went up 300% to 37, then up 300% from that point to 144. Damn, I wish I would have seen this stock, but it's so hard to predict this stuff. This stock is overvalued by 20%, making it a sell. The company faces significant risks from Google and Meta. Lots of insider selling. Simply Wall Street is bullish at 227. They say the stock is 35% undervalued. The reason Simply Wall Street's valuations are so high is because of the low discount rate, 6.8%. That's a discount rate on the equity. When you add the debt, it doesn't really change much, 6.81%. If I change my WACC to 6.8%, I get a valuation of $200. But that's a really low WACC. I don't know why that WACC is always so low. That's like a WACC from 6-7 years ago. Remember when interest rates were like below 1%? If you put money to a savings account, you may get 0.5% interest at best. 20 analysts priced this stock at $115. They say it's overvalued. Here's their free cash flow targets. The numbers I put into my DCF. 1.8 billion for 2024, 2.1 billion for 2025, 2.6 billion for 2026. They should use a lot of that free cash flow to pay down the debt. In 2018, their revenue was under $500 million. That's for all of 2018. It doubled to almost 1 billion by 2019. By 2020, up 50% to 1.5 billion. 2021, 2.8 billion. 2022, still 2.8 billion. So if you looked at the stock in 2022, you would have thought, this is not doing well, this company. Revenue is flat. Then for 2023, 3.3 billion, 2024, 4 billion. So their revenue isn't going up that much. At least not when you look at their free cash flow. Look how much their free cash flow has grown, almost exponentially. 1.4 billion. It was a little over 100 million. Now it's 1.4 billion. What is that, like a 10x growth? And here's the big black hole in the company. Debt, 800 million in 2018, up to 3.2 billion in 2021, up to 3.5 billion currently. Equity a lot lower than their debt. Equity was negative for a while, then it went higher than their debt. Now it's down to 800 million. Equity is assets minus liabilities on the balance sheet. So as they acquire more assets, whether organically from running their business or issuing new stock, that helps their debt to equity ratio. But when they issue more debt, that's kind of like a wash to the debt to equity ratio. Because when you issue $1 billion of debt, your debt goes up $1 billion and your cash goes up $1 billion. Unless you use the cash to buy another company. Still, your assets should go up $1 billion, because if you acquire another company, maybe you acquire their inventory, their real estate, or you just put whatever's left over into goodwill. And this green line is their cash. They have 460 million of cash, 3.5 billion of debt. So if they're paying 6% interest on the debt, 6% times 3.5 billion is about 210 million. So a little less than half their cash will go to the interest payments for the debt. But they are generating positive operating cash flow, so they'll be adding to the cash. The CEO salary went from 400,000 down to 100,000, back up to 400,000. That's an odd trend. Total compensation, 83 million. Tenure as CEO, 13 years. This is why there's so much stock-based compensation. That's where the 83 million is, plus other executives. Everybody and their mother is selling stock. The CEO, 200,000 shares. Other executives, 229,000. KKR, 3.9 million shares. KKR is a private equity firm in New York City. Private equity firms can put your company on the map and then drag them down and bankrupt you. So nearly 6 million shares were sold by insiders in the past year, which is about 2% of the shares. 55% of the companies owned by institutions, 38% by insiders, and 6% by the general public. The CEO is the biggest shareholder at 11%. It looks like there's lots of individuals that hold the stock. Vanguard at 6%, BlackRock. Silicon Valley Bank Wealth LLC owns 1.65%. SVB was acquired by First Citizens. Their employee count went from 900 to 1,700, and the ticker trades on the NASDAQ, the Börse München, Deutsche Börse, and Mexican Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.